So starting off here with a financial planning, of course, we have Tony and myself at Murray Nankivell. So we offer that service to all of our clients, non-SMSF and SMSF clients. And there's a lot of areas where financial planners can help with self-managed super funds. So reviewing your existing super funds, some people already have them set up. They may have had the best intentions and having a go at doing things, and they may find that it gets too complicated, or really they just want some advice to see if they're on track. So reviewing an existing super fund, developing investment strategies for ones that are starting up as well. And we sort of we put it to you what you can invest in. We also do risk profiles on all of our clients just to see, or perhaps we might have, for example, Mark and Emily come in and they're at this stage of life, which could be totally different to, say,
Tony and Jill.
Tony and Jill, yeah, we'll go with you. Yeah, so everybody has different appetites for risk as well. Some of us like to have a bit of a dibble-dabble, you know, heads up on the two-up table, and others tuck it under the mattress. So there's all different ranges, and that's where we can work on strategic planning and coaching you as well on where we think you should go and working with you. And the other areas, determining insurance needs and recommending the right provider and the types of insurance that you need. So yeah, back to where I've just been was your tolerance to risk and also your retirement goals. Some people are quite happy to retire modestly, and others, they want the top of the range Winnebago and they want to really live it up when they're retired. So all of that has to be addressed when you're looking at the long-term goals. Also building your assets outside of super. You don't want to have all your eggs in one basket in any instance. So it's another thing too, we don't only look at the investments within the super fund, we look at the whole picture of the clients. So people are investing mainly shares and managed funds, cash and term deposits. There's business property and residential property that Tony touched on, and a few other things, derivatives, unlisted trusts, life insurance and collectibles. That came up really quick. Yeah. So there is a cautionary area here with borrowing, and in this instance the J&M Super Fund, so they have a business premises of a value of 390,000, cash 10,000, and their assets are in total 400. So if one of these, John or Mary, something happened to them, they died, put that scenario, and there's not enough liquid assets to pay out the death or the disability benefit, because that's a requirement, then they'd have to sell down those assets in the fund. And as with the scenario before, if it's farmland, that can really knock you for a six if that's what you're relying on for your ongoing income as well. So a solution there is to have death and TBD cover, an amount in there. So John does get hit by a bus, and his benefits, the greater of the insurance proceeds or his account balance. So you can see how the scenario's changed there. John's estate does get paid out. It doesn't mean that Mary? Forgotten her name already. Yeah, it doesn't mean that those premises have to be sold to settle with dealing with John's death. So that's another thing they've bought in prior to June 30, 2013, so we're running out of time, but everybody has to address the investment strategy is so important. Well, it's an integral part of the self-managed super fund, but in the insurance now has to form part of that investment strategy. So look, a lot of people, they think, okay, I'm willing to sit with that risk. They might say, we've addressed it. Client, or let's say John, they're addressing this situation, and they need to have it noted and clearly detailed in their investment strategy. John considers that his $200,000 of life insurance outside of his super fund is sufficient enough. It just needs to be noted in there that it is addressed for each of the members of the super fund. So, and it has to be regularly reviewed each year as well. The benefits of the insurance in self-managed super funds. Show of hands, does anybody think that you can have life insurance in your super fund? Yep, for a few unsures. Yes, you can. Total and permanent disability? Yep, you can. Trauma cover. That's good, everyone's full marks there. There's some insurances you can have in SMSFs and some you can't. Well, you can have, some people have trauma cover in their self-managed super fund, but what's the good of that when the insurance company, they pay a claim, you get a cancer, they pay the claim to the self-managed super fund. You haven't reached any conditions of release, as in your age or financial hardship, you can't get that money out. So you're in the hospital needing these funds, suffering from a trauma condition, and it's stuck and it's there. So it's not advisable to have covers like that in your super funds. Life insurance and total and permanent disability, different ball game, because they tick the box on the definitions of this SIS definitions of conditions of release. So the benefits there, cash flow, the premiums are paid by the super fund, so it frees up after-tax income. You have an insurance policy in super, let's say it's a $2,000 a year premium. You can make a contribution or a salary sacrifice to cover that premium, but you can essentially make a payment to cover that premium and then claim that as a tax deduction. So there are bonuses there as well. Clearing debt is another benefit of the insurance in self-managed super funds. And like I said, you don't want anything trapped in there. You want it to be able to pay out benefits when you need it most. So first and foremost, with the insurance side, in superannuation, you want to get right amounts in the hands of the right people at the right time. So there are some pitfalls there, and we can advise on anything there to help you out.